what's up everybody? Josh Bennett with Money Masters here. In this video we're going to talk about something that I think is a little crazy that we have to have this conversation right now, but there's just a lot of craziness going on in the markets and the environments. But basically it's resetting, us as Americans, our expectations around what you can expect in terms of stock market growth. So right now, people are just throwing darts at a dartboard and, hitting mega winners in the stock market, which, is all well and good, but it is not an indication of history and where you should be investing your money right now. I mean, basically, I've had conversations with people that are disappointed with 16, 20% returns, or I've even had a conversation recently where someone was disappointed with 100% return on their stock portfolio this year in the middle of a pandemic. And that's just something that is, not realistic. And so I thought it'd be valuable to kind of reset expectations with everybody on what you can expect in terms of stock market growth. Like, what is good stock returns, and is now a good time to be, taking a ton of risk and, seeing what's going on in the market, jump all in and trade options, and, you only live once, have that type of mentality. The answer is, well, first off is no, but let's dig into kind of why that is and resetting expectations. So for us as investors, it is really hard to kind of see your neighbor, gaining a bunch of money by betting on Tesla and things like that. But, the fear of missing out is a huge fear in investing, just because, no one wants to watch their neighbor get rich and not get rich themselves. But, frankly, what people don't realize is that a lot of times you only are hearing from the winners. You're not hearing from the losers. So for every winner, there's an opposite loser. And so when you're involved in markets like we're in now, there are a lot of losers out there. You're just not hearing from them. You're just hearing from the winners, and most oftentimes they're amateurs that got lucky. And, history has shown that's not going to stand for long. And, just kind of dig into this and, kind of show you what I mean around this. And what tends to happen in these situations is you tend to be in a situation where people buy when the markets are really high and sell when the markets are really low, because of this emotion around watching your neighbors gain so much. And then, but by the time you buy in, that's when the market turns. So the idea is kind of like, say you went out on Black Friday and you were going to go buy a TV. Well, the TV for sale is normally $500, but the sales rep comes up to you and says, you know what? Today I'm going to give you that TV, $500 TV for $750. You'd look at them like they're crazy. Yet, that's exactly what people are doing right now with tech stocks especially. They're way overpaying for the value at hand. And I'm going to kind of show you kind of a history lesson around why that is not a good thing. But first, let's kind of dive into the investor psychology of all this. So as you can see here, what this is a study by Dalbar, which they do a lot of quantitative research on investor psychology and that sort of thing, compared in the kind of performance of individual investors and just professional investors. So what this shows is the average return of different mutual funds, but also then it shows the return of the average investors in those mutual funds. So there's obviously a big difference in terms of returns. And I've seen studies that are much more starker than this, where mutual fund returns 6%, investors return 4%. And the reason of that, because is they basically, what happens is a mutual fund goes up, does really well, investors see it, then one in on the action, so they buy in at the top, then the markets just do what they do and naturally come down. Investors panic or get disappointed because the returns weren't matching what the fund had previously done. They sell out, and next thing you know, the market's crashing and they're selling out of the bottom. So they're getting less return because of the emotional aspects of investing. And, when we look at that, so kind of comparing that to right now, when people are disappointed with 16, 20% returns, well, what's happening is, over time, those are actually extraordinary returns. So if you think of a 100% return, the highest returns on a given year within an asset class from 1985 to 2020 hasn't even been that high. So the average is emerging markets is 12.2%. And that's, you're talking investing in some pretty unstable countries at that point, where there's not a lot of infrastructure. There's potential for fraud and things like that. If we look at historic returns of U.S. stocks, it's about 10% over the long term. So anything beyond that is extraordinary. And I mean, even at that, you're still taking a lot of risk. So if you have $100,000 in a portfolio, I mean, you could see it drop 40%. So you could see it drop to $60,000 just to get that 10. So there is a lot of volatility. And when you have a situation like right now, where a lot of people are investing in like U.S. small caps or high risk stocks, I mean, you could see those drop even more just to chase this kind of similar averages. So I mean, look at like emerging markets can drop like 53%. So if you have $100,000, you could be out, down to 47,000. No one likes riding those drops, and that's why you see the emotion kick in. If you had $100,000 and start dropping to 70,000, that's where panic kicks in, and you try to save what's left, get out, but then you're too fear-stricken to get back in at the right time, and so you just sit on the sidelines, and ultimately you make less money. Whereas if you had just ridden the wave, you would have been fine. So that's what tends to happen, and again, with investor psychology, you get kind of wrapped up in this hype of what's going on. I mean, you see Tesla, which is up like, I can't remember the exact numbers, like 720%. And actually I was going to show you, so like this, I mean, even Warren Buffett, best investor of all time, arguably, his average annual return is only 12.2%, which is still great compared to the stock market, but 12.2% has made a billionaire. Again, billionaire with the B, and all he does is invest. He just invests really well, runs company and invests in. And so his return has still made him a billionaire at 12%. And yet you see, again, people upset with 100% returns. That's something that's not going on right in the markets right now. So, I mean, just to kind of drive this home forward about getting wrapped in the hype and kind of forgetting about history, if we look at this right now, so this is a visual of where we are in terms of like the market cap weightings in the S&P 500. So notice number 4 is Tesla, electric vehicle manufacturer. So cutting edge of where the car industry is going, and that's been kind of the story around it. Is Elon Musk is a genius. I mean, he is. No one can argue that. The cars are sexy. Like it's for all means and purposes a great company. And it is doing a lot of things to disruption when it comes to the manufacture of vehicles. And for that, it should be commended. But if we look at it from a valuation perspective, I've recorded other videos kind of diving into Tesla specifically in terms of valuation. But right now it's producing a fraction of the amount of cars compared to the overall market of automobiles, and yet it's still top in the S&P 500. So if we look at it's 4th in the S&P 500. But going back to history lesson, there's a little company called Cisco, or Cisco Systems. So Cisco was kind of the Tesla of the dot-com bubble. They basically were the backbone of the internet. So arguably just as disruptive as Tesla is these days, and they provided a lot of value to the economy, arguably more than Tesla did, and they were ranked 3rd in the S&P 500 in 1999. So you see it, Cisco right here, right behind Microsoft and GE. But if we look at the S&P 500 in 2000, Cisco is right here, still on the top, top 5, top 10. Well, let's look, start fast forward to 2001. Where are they? They're nowhere to be seen. And what's the reason for that is because Cisco ended up losing about 86% of its value during the tech bubble crash. So the backbone to the internet was so overvalued that it lost 86% of its value during the tech bubble crash. And just to drive that point home, we look here, like if you had invested $1,000 in Cisco stock in the dot-com bubble, today, 20 years later, it would only be worth $762. And so yet it was one of the high flyers, best performers going up to the tech crash. And so that's where these return expectations that are just outlandish compared to what a stock should be returning is where you get into trouble of, you may get those returns for 6 months, but then when the stocks crash, and they could crash hard because you're taking a lot of risks to get those returns, well, now you're in a position where you're not making any money at all. In fact, you may be 20 years down the line in a position that you're worse off than you were today. I'm not saying all this to be, huge Debbie Downer or anything like that. It's more, I just want you to be a student of history when it comes to the stock market and make sure you have the expectations around what are realistic returns when it comes to investing. Because not having realistic returns in your mind is what leads to you getting caught up in terms of the markets and getting caught up in the emotion of the day. And ultimately, you don't want to get caught up in the emotion of the day just because that's what leads your portfolio to a path of destruction, to the path of poor returns. Not to be melodramatic, but ultimately we're all in this to make money, build a wealth for our future and our future goals, our family, things like that. And you want to make sure that you are doing that in a way that will build safe and sustainable wealth. Chasing the high flyers of the day and getting caught in the emotion is not the way to do it. So again, not to be a Debbie Downer, hope you found this information valuable. There's a lot of great opportunities in investing. Just make sure you're taking the slow and steady route when it comes to investing. Investing is a game where the tortoise always wins versus the hare. So hope you found this video valuable. If you did, make sure you like and subscribe. Any questions, make sure you drop them in the comments below. Otherwise, look forward to seeing you on our next video. Cheers.